Good morning, my friends. Andrew Schartenberg, your mortgage engineer here. Today's Friday, January 14th, and I want to jump right into it today. Uh, where are rates? Well, they're holding steady. We are today on the conventional 30-year perfect scenario loans, which is Fannie Mae, Freddie Mac. We're talking 4.75%. And on the FHA, VA 30-year fixed loans, again, 0 points, perfect scenarios, about 4.5%. But the caveat here is that I think we may see them tick down slightly. We're on the verge of dropping down to the next level where we may see conventional rates go to 4.625 and FHA rates drop to 4.375. So why are we there? Well, I'm going to be the smarmy I told you so guy today, and just reiterate my negative feelings about the economy, and those are being legitimized through the economic reports that have been coming out this week for the most part. While some stuff's been a little mixed, today really the only bad thing for mortgage rates we saw was that the consumer price index came in at a actual 0.5% increase, and that's against the consensus of 0.4%. So it was very similar to what analysts had forecast, and what the consumer price index measures is inflationary pressures at the consumer level of the economy. So that's inflation, guys, and inflation is the antithesis of mortgage rates. Typically, when you're going to see inflation rising, you're going to see mortgage rates rising. But honestly, that is mostly due to a rise in gasoline and oil prices, as well as also a rise in some food prices, although gasoline is the biggest part of that, and I'm sure you've all seen it at the pumps. It's very painful, to tell you the truth, when I fill up my Jeep and I have to put in $80 to do so. Retail sales. Retail sales came in at an actual number of 0.6% increase versus a consensus of 0.8%, so that's less than what market analysts had thought. That's a good thing for bonds. It means that people aren't buying as much. Consumer sentiment slipped from an analyst consensus of 75 to 72.7, and this is a big caveat here. I had earlier said about the consumer confidence index. This is that's done by the conference board. This is the University of Michigan bi-monthly report, and you guys are about as negative about the economy as I am, apparently. A lot of that's due to weakness in jobs. So what's the net effect of this negative data that we've seen all week? Well, if you go on to any kind of money tracking website, economic tracking website, I like to use CNN, their money tab, so cnnmoney.com. You'll see that the 10-year Treasury notes are down. The yield on those is at 3.27%. We had been hovering around 3.35 to 3.38%, so we're down about 10 basis points, which means that we have more people moving their money into bonds, and hopefully we're going to see some decreasing mortgage rates. We're seeing the 10-year Treasury yield about the lowest it's been since early December, which is about when rates started ticking up. So if we continue with the negative news, I very well could see that rates are going up. Obviously, here in Rhode Island, guys, we need rates to be low. Regardless of what the rest of the country is doing, Rhode Island is not real strong. We're probably lagging behind in the recovery here, so I think that lower rates are only going to benefit our real estate market and obviously you home buyers out there. So my tip of the day is very closely related to rates here, and that is floating versus locking your interest rate. So some people don't know what that means. When you decide you need to get a mortgage, whether you're purchasing a house or you're refinancing a house, you need to make a decision with your mortgage professional. Are you going to float your interest rate or lock your interest rate? You lock your interest rate for a certain period of time, and that's the time that it takes to process the loan and get it to the closing table. Your mortgage professional is going to be able to help you with that. When you're buying a house, it's going to be dependent upon the length of the purchase and sales contract, which is typically going to go from 30 to 60 days. And when you're refinancing a house, usually it's going to be a 30 to 45 day process. So really we can basically say that it's smart these days to lock, if you're confident that it's going to go quickly, for 30 days. We can go out to 60 days, and that's how we lock the rate. So if you decided you wanted to go today at 4.75%, you would talk to your mortgage professional. They would lock your interest rate for you, and that would be your rate you close at. If you float your interest rate, taking a little bit of a risk. You're basically gambling at the market, the interest rate market, which obviously I come on here and tell you about every day. You're saying that it's going to stay the same or get better, meaning rates are going to decrease. It's a little bit of a risky proposition. It's good to come on here and listen to my rate report every day, as I'll give you recommendations on that, but honestly, usually most mortgage professionals' advice is if you're buying a house, it's usually smart to lock your interest rate. And the reason that we say that is because you decide to buy a house based on a certain payment, a certain price point for the house, and if you float your interest rate and rates go up, that can certainly screw with your monthly budget, and depending on the size of your purchase, it could be a difference of $50 a month, $25 a month, all the way up to $150 a month if there's a big jump, and that can certainly throw your finances off. So when you're in a contract to purchase a house, it's usually smart to lock your interest rate because you know what you're getting on that day. Now, it's not going to always be right for everybody, but generally speaking, that's the safe bet. And I'm kind of a conservative guy, so that's usually what I recommend. Now, if you're refinancing, again, it's really kind of going to depend a little bit on where your mortgage professional sees rates going. If somebody came to me today, I might say we might want to hold off until Monday or Tuesday and see if our negative news continues and see if we're going to get down to those lower mortgage rates. But honestly, when you think about it, I'm talking about a potential decrease of about 1/8% if we see the negative economic news continue. If you're going to be saving over 1% on your loan and rates were to jump, then obviously you're not going to be saving that 1% anymore. So it could totally keep you from refinancing in the first place. So you're basically gambling on the positive side to decrease another 1/8%, but you're also taking the risk of not being able to do it at all if rates were to rise. So it gets to be a little bit more complicated when you're refinancing a house, whether you should float or lock your rate, and you really need to talk to a competent mortgage professional about that who understands things from a financial perspective. But that's kind of a general primer on floating or locking, and always make that decision with the person that you're working with. That's all for today, guys. If you ever need to reach me, you can get me on the web at andrew@otfunding.com. That's my email address. Again, andrew@otfunding.com. Have a great weekend. Let's hope we don't get any more snow, and go Pats.